Hello and welcome to this video. In this video, we are going to do a question from paper 3 specimen paper 2023 question 3. The question states that Amel and James are in partnership. Their statement of financial position on 1st January 2020 was as follows. Assets, non-current assets in which we have land and building which is $40,000. Office equipment is $16,000. The total is $56,000. Current assets in which we have inventory of $10,000, trade receivables of $19,000 and cash at bank as $6,000. The total is $35,000 and the total of all the assets, that is current as well as non-current, is $91,000. Then we have the capital and liabilities. In capital we have Amel's account which is $43,000, James account which is $25,000 and the total is $68,000. Non-current liabilities, 4% loan from James which is $9,000. Then we have current liabilities which is $14,000 and the total liabilities, that is the total of this 9,000 and 14,000 is $23,000 and the total of capital and liability, that is 68,000 plus 23,000 which is $91,000. Furthermore, additional information is provided. M Limited took over the business of partnership of Amel and James on 1st January 2020. The following information is also available. The partners did not keep separate current accounts. Amel and James shared profit and loss in a ratio of 2:3 respectively. The assets of Amel and James are valued at land and building $50,000, office equipment $14,000, inventory $8,000, trade receivable $16,000. Amel will take a computer which has a value of $2,500. M Limited will take over all the remaining assets and liabilities of the partnership with the exception of James loan and the cash at the bank. The terms of the sales are M Limited will issue a 6% debenture which will be redeemed in 2029, that is 2029, to cover the loan from James and to ensure his annual interest income remains the same. The company will issue 50,000 ordinary shares of $1 each at a premium of 20 cents per share. These are to be allotted to Amel and James in their profit sharing ratio. The balance of sales proceeding will be $20,000 and will be paid into the partnership's bank account. In the A bit of the question, we are asked to write the difference between inherited goodwill and purchased goodwill. What is goodwill? Goodwill is the name and reputation, a good name which is developed in the market based on the performance of the business, that is goodwill. And when we talk about the inherited goodwill, it is the goodwill which is built over a period of time because the reputation of the business was so good, because they have good loyal customers, because they have served the customers in a very efficient way, they have paid all the credit on time, or they are very loyal and ethical, and they have a good location, and because of all these reasons over a period of time the business have developed a goodwill, and this is built over a period of time. This is not purchased from someone else, hence it is not included in the financial statements. Whereas purchased goodwill, this is the goodwill which another business acquires when they purchase the existing business. When they purchase the other business, then they pay something which is more than what should be paid for the assets, net assets which they are acquiring. The excess of purchase consideration or the fair value of the net assets is considered as purchase goodwill, and this is recorded in the financial statement as an intangible assets because we can't see the goodwill, hence it is intangible non-current assets. In the B bit of the question, we are asked to calculate the amount of debenture to be issued to James, and it was mentioned that the James have a loan of $9,000 and it was at 4% interest. So when we find this 9,000 times 4%, we get the interest which was paid to James per annum was $360. Now what they are saying is they want to keep this interest same even when M Limited have taken over the company. So they should be, this 360 should remain same. So how we calculated this? We took the loan amount times 4%, we got this $360. Now we don't know what will be the loan amount because we have to calculate this and then we have to issue the debentures, and they are saying that they are ready to pay a 6% interest, and we should get $360 because this is the interest which has to be paid to James annually. So if we take this, that is here it's in multiplication, if we transpose it to the other side it will go in division. It will be, the loan amount will be 360 divided by 6%, we get the value as $6,000. So this should be the amount of debentures which should be issued to James so that he will earn the same interest, that is $360 per annum even after the purchase of partnership. In the snippet of the question, we are asked to prepare the journal entries in M Limited's book to record the purchase of the partnership. A narrative is not required. You see here we are making the journal entry in the books of M Limited. M Limited is a purchasing company, so when they purchase, naturally assets will come in, and whenever there is an increase in assets, we debit it. And here the assets will be at a revalued cost because they are purchasing at a revalued cost. When there is a sale of partnership, they revalue all the assets and then they sell it at a revalued value, and this value will be mentioned here. Apart from that, if the business is also taking over the liabilities, then liabilities, increase in liabilities is credited, and then there will be a purchase consideration. This will be in the forms of shares and debentures which the new business will issue to the existing business, and this is equity and capital is always credited whenever there is increase, so we credit this. And then when there is a business purchase, this may also lead to a goodwill because mostly existing business do have goodwill, and the purchasing business pays a amount greater than the value of assets and liabilities which are taken over, so this will lead to a goodwill, and this will be the balancing figure, and this is how we make the journal entry whenever there is a business purchase. Before proceeding and making the journal entries, let's do the calculation to find out whether there is a goodwill, and we'll do this in our working notes. It is given that the assets of Amel and James are to be valued as follows, and this will be the sundry assets. Land and building $50,000, so I've taken $50,000. Office equipment is $14,000. It is also mentioned that Amel has taken a computer value of $2,500, so we are going to subtract this $2,500 from $14,000. we will get $11,500. Then the inventory is mentioned, which is $8,000, and trade receivable as $16,000. so the total of the sundry assets is $85,500, which will be mentioned here. Then we have the liabilities is also taken over, so this will be an outflow of cash, so it will be $14,500. so the total of sundry assets and liabilities taken over will be $71,500. Now furthermore, it was mentioned the terms of sales, and this is the purchase consideration, where it was mentioned that M Limited will issue 6% debenture 2029 to cover the loan from James and to ensure his annual interest income remains the same. The company will issue 50,000 ordinary shares of $1 each at a premium of 20 cents per share, and this will be allotted to Amel and James in the profit sharing ratio. The balance of sales proceedings will be $20,000, and this will be paid into the partnership bank account. So let's do the working for this. The purchase consideration which we get from this sixth additional working notes given was the 6% debentures, and we have calculated the amount in our bid B, and should be $6,000. Then the ordinary shares, which they are saying that is share price is $1 each, so 50,000 times A times $1 will be $50,000. Then the share premium is 20 cents, so $50,000 times 20 cents will be $10,000, and they are going to pay some amount in the bank which is $20,000. so the total amount of money which M Limited is willing to pay or is paying when they are purchasing the partnership is $86,000. Now, as we have done all the total of sundry assets and liabilities in our first working notes, we got that as $71,500. so this should be the sundry asset value of the partnership firm. However, the business is paying $86,000, so this difference between this $86,000 minus $71,500 will be the goodwill, which will be $14,500, which the business M Limited is purchasing from the partnership. Now, as we are done with all the calculation, let us proceed and make the journal entries. Here we are going to take all the assets on the debit side because increase in assets are debited and all these assets are coming in M Limited company. Hence, assets like land and building, which was given as $50,000, office equipments, which we calculate in the working notes as $11,500, inventory $8,000, trade receivable $16,000, and goodwill, which we have calculated, and this will be the balancing figure, which will be $14,500. These all are assets, and as they are coming in, which will lead to an increase in an asset. So based on our accounting equation, assets, if they are increasing, we debit it, and then the liabilities, if they are increasing, we credit it. So here we have the current liabilities, which was $14,000, debentures, it's a long-term loan, it's $6,000, and bank, this is a payment from bank which was done by M Limited, and as This leads to decrease in the assets of M Limited. Hence, it's vice versa. That is, if there is an increase in assets, we debit it. If there is a decrease in asset, we credit it. So hence, we are crediting this bank balance 20,000 here. Then we have ordinary share capital. Again, it's an increase in the capital. Hence, we credited, and share premium. It's also a increase in capital. So it's 10,000 is credited. So with this, we have completed the journal entry. In the debit of the question, we are asked to prepare partner's capital account to show the closure of partnership. You see, wherever there is a closure, when we are closing the business, we sell all the assets and liabilities, and when we sell all the assets and liabilities, so they may be either profit or loss on the sales of all these assets and liabilities, and as we are making partner's capital account, this profit or loss have to be included in the capital account, and as this is a closure, we will make it in the books of a partnership firm which we are going to close. So for this reason, what we will do is we will see whether there was a profit or loss when we released these assets and liabilities. For that, we make the realization account, and as we need to make the capital account, we will make this realization account in the working notes and then proceed forward to make the capital account. Then here we have all the assets which we are releasing, and all the assets will have the debit balance. So I bought all the assets from the first part of the question where it was mentioned the assets and liabilities which was on the book value of the partnership. So we have land and building of $40,000, office equipment of $16,000 minus $2,500 which was the computer which was taken by Amel, and hence we got $13,500. We have inventory as $10,000, trade receivable as $19,000, and current liability, because it's a liability on the credit side, it's $14,000, and this was a purchase consideration which we have calculated earlier, and this was the price which M Limited was willing to pay for taking over all the assets and liabilities. So as they are taking over all these assets, hence this is to be credited as purchase consideration $86,000. If we total on the credit side, it is $100,000, and if we total it up from the debit side, it is $40,000 plus $13,500 plus $10,000 plus $19,000, and it will be a total of $82,500. So it is deficit on the debit side. So what we do is we balance it by getting the balancing figure, and here you see we are getting more money when compared to the assets and the liabilities which we are giving off. So this excess of money will be the profit on realization, and this have to be distributed among the partners in the profit sharing ratio, which was 2:3. So we will distribute it. Amel, it is 17,500 times 2 by 5 because the ratio was 2:3, so the total is 5. So 2 by 5, which we will get as $7,000, and for James it is 17,500 times 3 by 5, which will be $10,500, and when we total it up, it is $17,500. Now the balance on both the side is same, that is $100,000 and $100,000. This, what we have it here as realization profit, will be taken in the partner's capital account, and with this we have completed the realization account. Just as a side note, because most of my students have a doubt that why goodwill was calculated and why realization profit was calculated, and why the value of goodwill was $14,500 and why the value of realization is $17,500. Goodwill is calculated when there is a purchase of business. As M Limited has purchased the business, hence M Limited has calculated the goodwill because they have purchased this goodwill as well. So this is recorded only in the books of M Limited, and it is not recorded in the books of partnership. It will be recorded only in the book of M Limited, who is purchasing the business. And when they are purchasing the business, this will be purchased at a revalued value. Hence we have taken the value of assets and liabilities from the additional note. So the value here taken is the revalued value, not the net book value of the partnership firm. Whereas when we go for realization profit or realization account, this is the closure entry in the books of partnership. So when we are taking the closure entries, so the value of assets and liabilities will be on the basis of the net book value, which was mentioned in the book of accounts of the partnership of Amil and James. So this may be different because here the value is net book value, not the revised value of assets and liabilities, and based on this we got a different realization profit, that is, it is 17,500. Before making the partnership capital account, let us also calculate the ordinary share capital and how it is divided between Amil and James. Amil's ordinary share capital will be in the profit sharing ratio, so it will be 60,000 times 2 by 3 plus 2, because that was the ratio 2:3. So 3 plus 2 will be 5, so it will be 60,000 times 2/5, which will be $24,000, and for James it will be $60,000 times 3/5, which will be $36,000. And then here we have the partnership capital account, and as we have the rule form, our accounting equation, assets is equals to capital plus liability. Any increase on the this side, that is on the asset side, will be debited, and any increase on the capital and liability side will be credited, and we will have the opening balance of capital and liability on the credit side. So we are starting here with the opening balance, which was mentioned in the book of accounts as the $43,000 for Amil and $25,000 for James. And the profit on realization, which we have calculated in our working notes, as this increases the capital, hence we have mentioned it here as 7,000 and 10,500. And apart from that, there was a loan which was given by James, and this have to be repaid, and this is also a part of capital because we don't have a separate current account here, so we are going to mention it here as $9,000. And then how we are going to repay this is repaid by the ordinary share capital, which was issued by M Limited, and as we are repaying this, that is, we are reducing the credit balance, so we are mentioning it on the debit side by $24,000 and $36,000. Apart from that, Amil have also taken an office computer, which will also reduce the capital, and as this is reducing the capital, we will mention it on the debit side as $2,500. And this loan which was given by James, now it is paid by means of debenture, so this have to be reduced, hence we are mentioning it on the debit side as $6,000. Apart from that, whatever is the remaining balance of the capital which is due for Amil and James have to be repaid, and this will be paid by means of bank, and this will be the balancing figure. Whatever balance is left is repaid, and hence the capital account will be closed. So it is the balancing figure. If you see the balance between the debit and the credit, you will get this balancing figure, and this is $23,500 for Amil, and for James it is $2,500. So when we total on both the sides, it's $50,000 for Amil and $44,500 for James, and this is $50,000 and $44,000 on both the credit and the debit side. In the A bit of the question, we are asked to prepare the partnership bank account recording the closure of the partnership, and this is a bank account, so debit side will be the receipt side and the credit side will be the payment side. And as this is an asset account, whenever there is an opening balance, it will be on the debit side unless it is a bank overdraft, and here we have cash at bank. So, and as we have cash at bank, this will be the opening balance, and this will be on the debit side, and this was mentioned in the starting of the question as $6,000. And then apart from that, even M Limited have paid some money when they have gone for the purchase consideration. They have paid $20,000, which was mentioned in the additional note, and as this is a receipt, hence it is debited as $20,000. Now when we see on the credit side, this is the amount which is paid, so this is an outflow from the bank account, and the capital account, which we have already calculated in bit D, where we have debited that capital account. Now we will credit it to complete the double entry, and here we have Amal's value, which was mentioned there as 23,500 and James value as 2,500. So with this we close the bank account, and the total on both the sides should be equal, so it is $26,000 here and $26,000 on the credit side. With this we have completed this question. Thanks for watching my videos. Have a peaceful and blessed life.